Hello and welcome to Asking for a Trend. I'm Josh Lipton. Earlier this week, President Trump said the U.S. will impose 25% tariffs on imports of cars and car parts, set to take effect on April 3rd. The measures will apply to both finished cars and trucks. And joining us now for more is Yahoo Finance senior autos reporter Praz Subramanian. Praz.
Hey Josh, yeah, we're at a dealership here in New Jersey. We're seeing a lot of foot traffic as people sort of maybe try to come in ahead of those tariffs. A lot of concern, it seems, from customers and also dealers, salesmen and dealers that work here about what will happen, especially for import cars like Lexus that we see here. Most of their cars are made in Japan. It's a big problem when 25% tariffs take place next week.
And Praz, you also talked to the Lucid CEO about tariffs. What did you learn from that conversation?
Yeah, so Lucid's new interim CEO, Mark Winteroff, was in town. They had an event last night debuting the new Gravity SUV here. Basically, that car, that EV SUV, is going to go on sale in April, which is big for them because that's their more volume car. He mentioned the fact that because of the fact that they make every vehicle in the U.S., they're sort of insulated from tariffs, obviously, but because of the global supply chain, they do stuff like battery cells from other countries. That's going to hit them. They're a little bit concerned about that, and also concerned about the threat to the EV tax credit going away. That's also a big deal for them. If that goes away, that's going to be a problem to make their cars more competitive. Layer on top of that, potentially tariffs on goods like battery cells, and it becomes a tough market for these automakers to navigate. All
right, thank you, Praz. We'll check back in with you later in the show. President Donald Trump's 25% tariff on new vehicles made outside the U.S. is likely to negatively impact car makers, but our next guest says it represents a positive for domestic auto parts operators, such as AutoZone and Advanced Auto Parts. From one now, let's welcome in David Bellinger, Mizuho America's director and senior analyst. David, it's great to see you. So President Trump, of course, planning to impose 25% tariffs on imported vehicles, and consumers, investors, business people, David, all trying to figure out the ripple effects of that. You argue it could be, though, a positive for the auto parts makers. How come, David? Walk us through that.
Yeah, exactly. Thanks for having me back on, Josh. And tariffs have been a good thing for auto parts in general. Prices go up. You've got a lot of pricing power here. Eventually gets passed on to the consumer. But if you have these new vehicle tariffs come into play, that should, in effect, push more used vehicle sales in the process. And it'll basically allow consumers to hold on to their cars longer. So that this has been a dynamic in the U.S. for many, many years now. The average age of the car on the road in the U.S. is almost 13 years old. So you've got cars that are lasting longer. You could drive them for a couple 100,000 miles instead of just 100,000 miles if you think back a decade ago. But people want to keep investing in these. Used car prices have gone way up, 30% higher than 2019 levels. So you see that as an investment. And the more and more that average age of vehicle on the road goes up as you get more and more used car sales versus new, that should help all these guys advance. AutoZone, O'Reilly, and just the need for parts continues to grow.
And how expensive, though, David, is that going to get for folks there to repair their cars they already own? Because doesn't the price of the parts also go up?
That's exactly right, but it's a lesser increase than if you're buying a new car. So if you could shell out a few $100 to keep your car on the road versus going out and buying a new car, we've heard some of these monthly payments for new cars could be $700, $800, $900 a month. And that's not for anything special. We're not talking about a Maserati here. You're talking about a Honda Civic, right? Just with their interest rates have gone and used car prices have gone. So it's almost unaffordable for a decent set of consumers. But from that relative value perspective, if you could throw a few $100 into your older Ford F-150 to keep it on the road, keep you getting to work, bring your kids to school, you'll make that trade any day.
Let's get to some picks here, David, to play this theme. One I know you like, I think it's your top pick, O'Reilly. That one I'm just looking here. It's already up about 20% so far this year, but you say it's still a buy here at these levels?
Yeah, that's right. We've got an upside target of about $1,700 on O'Reilly shares, and this is a great secular growth story. They still have room to grow stores in the U.S. They're also going international, opening some stores in Mexico here. But the demand dynamics of this business are simply incredible, right? You've got a lot of cars on the road, almost 300 million cars in the U.S. Miles driven are up. There's a lot of jobs out there. So people are out and driving. That leads to repairs. It's just a very, very steady business model. they deliver parts to their more commercial operators, right? So you think about their business leans more towards professional parts people versus the do-it-yourself customers. That's where a lot of the growth is on that pro side. They can deliver a part to those customers in under 30 minutes. So it's really difficult model to replicate. Plus, you've got O'Reilly buying back a lot of their own equity. They're going to do a stock split here soon. And I think that'll even allow them to buy back shares better than they have just with more volume out there. So a good name and still one of our top picks here.
And off this same thing we're talking about, David, is AutoZone, which has also had a nice run already in 2025, but you say stick with it. It's a buy.
Yeah, very similar story here. AutoZone leans more to that do-it-yourself customer. It's about 75% of the business in the U.S., but they made all these investments to grow that commercial side. They've got a relatively new CEO in place. He's an AutoZone veteran, been there for years, but he's coming in and also adding that international story here. But these investments on the commercial side have really hit scale, and that business should accelerate through the balance of the year, and the tariffs certainly will help.
Final one I want to squeeze in here, CarMax. Now that one, stock's in the red this year and over the last 12 months, but you've been telling your clients it's a buy.
We've got a neutral rating on CarMax.
I apologize, a neutral on that one, dude.
No problem at all. The same store sales, the unit sales growth for CarMax has been a little lumpy because those prices have been so high, right? It's been a bit of a detriment to that customer base that's under a little more pressure. But if you have tariffs on these new cars coming in, that could shift a lot of volumes into the used space. So this is a developing positive for CarMax within the context of our neutral rating here. But if you see some of this share shift from new to used, it's a big positive for them. And the used car space is huge. You're talking almost 40 million unit sales a year. New is about 15 million. But any shifts in those percentages, you're talking about hundreds of thousands of vehicle volumes that could be up for grabs for someone like CarMax or their peer Carvana that's out there and does more of the e-commerce aspect of that space. But probably a good thing for both of those guys if you do get these 25% tariffs coming in on the new cars.
David, thank you so much for your time today in those stock picks. Appreciate it.
Absolutely. Thanks, Josh.
And coming up, we're heading back out to the Garden State to hear from the owner of a car dealership to discuss the expected impact of these auto tariffs. Stick around, much more Ask for a Trend. That's right on the other side. Well, you might start seeing higher prices at your local car dealer with President Trump's auto tariffs set to take effect next week. Yahoo Finance senior autos reporter Praz Subramanian is joining us now from a local dealership. Praz.
That's right, Josh. I'm here in New Jersey, Celebrity Motor Cars Lexus dealership here. Joining me is Tom Maiola, the owner of the dealership, and also a number of other brands in the area. So, Tom, I think a lot of people are talking about what's the tariffs going to mean? What's it going to mean for everyone here? What are you seeing right now at the dealership floor?
Well, we're seeing people come in, they want to buy cars because they're afraid. They don't want to pay that 10% additional. The average car in the United States of America now sells for $40,000. So you're talking about a $10,000 increase. When you finance that out, it's about $30 $1,000. It's $300 more on a payment. They want to buy now.
I was shocked to hear that $300 more additional to a payment that, for some people, they're already paying almost $1,000 on a payment. I think there's some talk about how the dealers, what are they doing to prepare to sort of insulate their customers from the tariff effects?
Well, listen, there's not really much we can do right now. The only thing we can do is build up inventory, try and get inventory from the manufacturers as much as we can, whatever's on the ground in the ports, and the same thing on the part side because it's going to affect repairs. That same 25% tariff is going to affect repairs. Repairs are going to go up. And if they're not buying, consumers have to repair because they have to keep their cars on the road. You can't stop transportation.
So you're going to have older cars on the road being repaired with more expensive parts, right?
That's correct.
With regards to the new market, and we're in a Lexus dealership right now with most of the cars coming in from Japan, are you concerned that new car sales are going to crash?
No, listen, they're not going to crash because, as I said before, you can't stop transportation. Ultimately, the consumer's going to have to do one of three things. They're going to buy a new car at the higher price, which that's going to, I believe, pull back. They're going to either fix their car and elongate the cycle, keep their car for 150,000 miles and just keep it glued together, or they're going to try and buy a used car. And the used car market's going to skyrocket because there's only a certain amount of used cars out there, and that's an alternative to buying a new car.
I know you work with brands like BMW, Mercedes,
Yes.
Ford, Lexus. Different sort of scenarios for each brand, but overall, it's concern, right?
It's a concern and it's consistent. And it's interesting because if you look at what happened in the stock market yesterday, all the domestics, GM, Ford, Chrysler, Stellantis, they all crashed. So this is not really helping the domestics by doing this because they buy their parts from overseas also. So they're getting their parts from Mexico, Canada, China, Japan. So it's going to affect them also.
I know that you were involved with the Trump transition team in his first term. You're close to the Republican Party.
Yes.
What would you tell President Trump and some of his advisors? What should they be doing right now? Is this the right move, is I guess what I'm trying to say?
Listen, he's a brilliant man. He knows what he's doing. But I could tell you that if I were to make this decision or I sat down with him to talk to him about it, I would say, change the methodology. And instead of doing this with a stick, do it with a carrot. We want to drive manufacturing back to the U.S. And if you do it with a carrot, you offer tax incentives, offer interest-free loans to the manufacturers to put their plants here, and if you get interest-free loans with long-term paybacks and tax incentives, they will come anyway. They're going to build it here anyway because that's how it happens. Look at real estate. If you look at Florida, you ride down the highways of Florida and there's cranes everywhere. It's because they have no state tax, so there's an incentive. And so I would say, forget the stick and do it with a carrot.
Carrots like incentives, I think, might be a good idea for bringing back those jobs, which are high paying here. So, Tom, we're running out of time here. Thanks so much. Really appreciate Tom
Absolutely.
Aioli at Celebrity Motor Cars. Thank you. Back over to you, Josh.
All right, thank you so much, both Tom and Praz there. Stick around. Much more Asking for a Trend right on the other side. Consumer sentiment falling to lowest levels in over 2 years with inflation worries rising ahead of new tariffs. We're taking a look at our chart of the day at how consumers are spending amid this uncertainty. And Yahoo Finance's Julie Hyman joins us now with a closer look. Julie.
Of the many questions that we are asking ourselves currently is, we know that people feel bad. We've got the sentiment data, but what are they actually doing in terms of spending? And how is it being affected by the upcoming auto tariffs and whatever other tariffs we might learn about next week? We got a little bit more insight into that today with the February consumer spending data. It was part of that big release that also included inflation numbers. And if you look at the breakdown in goods versus services, we can ask the question, did people order or buy more things that they thought were going to eventually be tariffed? The answer is maybe. We don't yet know. We're going to have to look at the data in the coming months to see if there was any pull forward effect. But what we do know is that we saw $21 billion in other non-durable goods bought during the month of February. That can include everything from paper plates to other types of non-durables. You've got motor vehicles. Obviously, this is an important piece here of almost $13 billion in sales. Again, are we going to see that number then fall off as we potentially see prices rise? There was some evidence that we saw dealers ordering more vehicles ahead of some expected tariffs, although it wasn't clear exactly what tariffs we were going to see on autos until just this week. So again, we're trying to process all of this. Food and beverages at $10 billion, recreational goods and vehicles at about the same amount. Furnishings and durable household items are just under $5 billion. And then you have other durable goods, clothing and footwear, and then find gasoline going down. And we should mention, these are not inflation adjusted numbers. So we know that gasoline, we've been seeing some waning prices. So again, a little bit of a snapshot here. We'll have to look at the trend in the coming months to see how these numbers change based on availability around tariffs, based on pricing because of tariffs, and also just general market sentiment and consumer sentiment to see if how these consumers are feeling is indeed going to translate into these numbers, Josh.
All right. Thank you, Julie. Meanwhile, Trump's auto tariffs go into effect April 3rd. That means prices for vehicles are expected to rise. Even consumers looking to the used car market for relief could be out of luck. Edmunds head of Insights, Jessica Caldwell, joins us now to discuss. Jessica, it is great to see you. So with these tariffs, Jessica, we know what Trump is trying to achieve here, wants to encourage more domestic manufacturing, but that's a long-term goal. In the near term, we could see some ripple effects. One would be these automakers, Jessica, likely are now going to have to deal with higher costs, right? I'm curious how you think they're going to deal with those higher costs. Are they going to take the margin hit? Are they going to pass those along to Jessica and Josh? What do you think?
Well, given that they're 25%, no automaker can absorb 25% of costs. The margins are just not that great in the auto industry. So some of it is going to be passed along to the consumer. That is the $25,000 question because we don't know exactly how much. I wouldn't say if you look at a vehicle, see where it's made, and then apply those tariffs to it. I don't think that really is going to happen. I think automakers will probably look at the entire lineup of vehicles that they sell and see where costs can be mitigated, see where it's going to cause the least amount of damage for their sales to their consumers, where maybe people can take a little bit more of a price hike. Someone buying a $100,000 car is probably not as price sensitive as someone buying a $20,000 car. So it's going to be probably not particularly straightforward, but we do know prices are going to go up.
So they are going to rise, Jessica, but your point is it's hard at this point to quantify how much?
Yeah, I think so, just because there's a lot of moving parts here. And I don't think that it's going to be this vehicle has gone up, this vehicle's tariffed by this much, so the price is going to go up by this much as well. Because I think, firstly, automakers will get rid of incentives. They're probably not going to have incentives of vehicles if they have to raise prices. They will probably absorb some of the costs themselves, see how much they can take. And then thirdly, start to raise prices for these vehicles. And I imagine it's going to look different for every brand and for every vehicle.
So Jessica, given that, I'm just curious, how do you think consumers are going to react and respond then? Do you think do they keep buying new cars or no? Do they look to the used car market? What do you think?
Well, at the end of the day, people need cars in this country to get from point A to point B. So we may have to see people sit out of the market. But obviously, what we have seen in the past few years is that consumers have been pushed to the brink of affordability. New vehicle transaction prices have gone up 29% in the past 5 years. And then you think about adding additional tariff costs to that, people are going to just face complete sticker shock. They're not buying cars every month. They come into the dealership once every 6 years and look at these prices. So that's an extreme cost of what we see people doing. So I think that to skirt this tariff issue, people will start to look towards the used car market if they need to buy a vehicle. And just like we saw in the semiconductor shortage a few years ago, when people start shifting to used, then those prices go up as well. So there's not going to be a lot of relief here if people want to buy a vehicle in general.
And even if they want a used car, Jessica, let's say that's where they want to go. What are inventories like right now?
Well, used car inventories are tough. I mean, what we're seeing, right now is we're not going to see a lot of lease returns come back in 2025. 2022 was a pretty low year for leasing in general. So the used car inventory, if we just look at that inventory, is not exactly at the best point ever to absorb all of these new customers. So the prices may be just higher from that already.
Do you think, final question, Jessica, we could see more Americans just spend more repairing the cars they already have? I was talking to a financial analyst earlier in the show who thought, in his opinion, that's a trend to watch.
Yeah, I mean, I think that is definitely going to happen. I mean, obviously, we're going to see costs go up on parts as well because of the tariffs, but I think people will start to think, let me see how much this vehicle I'm going to keep is going to be cost to repair rather than go out and buy a new one. Because if you buy a new one, you're not only dealing with higher prices, you're dealing with higher interest rates as well. And then also insurance costs. I mean, insurance costs will probably go up because of, parts and aluminum steel tariffs. And will it cost more to insure a new car versus the used car that I already have? So it's not just to hear about buying a new vehicle with these tariffs. It really is about total cost of ownership. All right. Next week, it could get busy. Jessica, thank you so much for your time today. Appreciate it. Sure. Thank you. That is a wrap on today's Ask for a Trend. Be sure to come back Monday at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet. Have a great night.